studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Before you can determine the tax treatment of an automobile, you must answer one fundamental question. Who owns the vehicle? This is the starting point for every automobile tax analysis, because the ownership of the vehicle determines which set of tax rules will apply. There are two possible situations. In the first, the corporation owns the automobile. The corporation purchases the vehicle, pays for expenses such as fuel, insurance, repairs, maintenance, and financing costs, and then allows an employee or shareholder to use the vehicle. That use may include both business driving and personal driving. In the second situation, the individual personally owns the automobile. The employee or shareholder pays all of the vehicle's expenses personally and uses the vehicle for both personal and business purposes. The corporation may then reimburse the individual for business-related travel or pay a mileage allowance. Although both vehicles may be used for business, the tax consequences are very different because the ownership is different. When the corporation owns the vehicle, personal use may result in taxable automobile benefits under the Income Tax Act. When the individual owns the vehicle, those specific automobile benefit rules generally do not apply. Instead, the focus shifts to mileage reimbursements, automobile allowances, and deductions for business use. This is why experienced tax preparers never begin by asking how the vehicle was used. Instead, they first ask, who owns the automobile? Once ownership has been established, the correct set of tax rules can be applied, making it much easier to determine how expenses, reimbursements, deductions, and any taxable benefits should be handled. The key takeaway is simple. Ownership comes first. Everything else, the tax treatment, allowable deductions, reimbursements, and potential taxable benefits flows from the answer to that one important question. Now that we've identified who owns the automobile, let's see how that ownership changes the tax consequences. If the corporation owns the vehicle, the corporation is responsible for paying most of the vehicle's costs. These typically include fuel, repairs, maintenance, insurance, tires, lease payments, or loan payments. The employee or shareholder may then use the vehicle for both business and personal driving. This personal use is important because it may create taxable automobile benefits under the Income Tax Act. The two major benefits you'll study in detail are the standby charge and the operating cost benefit. These rules are designed to calculate the value of the personal benefit received when someone uses a company-owned vehicle for personal purposes. Now compare that with a personally owned vehicle. In this case, the individual purchases the vehicle and pays all of the related expenses personally, including fuel, insurance, repairs, maintenance, and financing costs. When the vehicle is used for business purposes, the corporation may reimburse the employee or shareholder using a mileage allowance or another approved reimbursement method. Because the corporation does not own the vehicle, the standby charge and operating benefit rules generally do not apply. Instead, the focus shifts to determining whether the reimbursement is reasonable and whether proper mileage records have been maintained. Notice that the actual business trip may be exactly the same in both situations. The only difference is who owns the automobile. Yet that single difference completely changes the tax rules that apply. This is why ownership is always the foundation of automobile taxation. Once ownership is identified, you can determine who pays the expenses, whether any taxable benefit may arise, and which set of tax rules should be applied. The key takeaway is simple. The same vehicle use can produce very different tax results. In Canadian tax law, ownership changes everything. Think of this slide as the roadmap that every tax preparer follows before applying any automobile tax rules. Rather than memorizing dozens of rules, experienced accountants begin by asking a series of simple questions in the correct order. The first question is always, who owns the automobile? If the corporation owns the vehicle, the corporate automobile rules apply. The tax preparer then determines how much of the driving was for business purposes and how much was for personal use. Personal use may result in a standby charge or an operating cost benefit, both of which we'll study in the next sections. If the individual owns the vehicle, a completely different set of rules applies. Instead of calculating taxable automobile benefits, the focus shifts to business kilometers, mileage logs, reimbursements, and allowable expense deductions. Once ownership has been established, the next step is gathering supporting documentation. A tax preparer will review mileage logs, fuel receipts, insurance records, repair invoices, maintenance costs, and calendar records to verify how the vehicle was actually used. They also need to determine who paid the vehicle expenses. Were they paid by the corporation or by the individual? Was the employee reimbursed? Was a mileage allowance paid? These answers determine the correct tax treatment. Notice that every step follows a logical sequence. First, identify ownership. Then determine business versus personal use. Review the supporting records. Identify who paid the expenses. Finally, apply the appropriate automobile tax rules. Following this structured decision process helps prevent one of the most common mistakes in automobile taxation: applying the wrong rules because ownership was never identified at the beginning. The key takeaway is simple. Every automobile tax analysis begins with ownership. Once you know who owns the vehicle, the rest of the analysis becomes much more straightforward, allowing you to apply the correct rules for deductions, reimbursements, and any potential taxable benefits.